Good morning, everybody. My name is Jonathan Walton. I'm a director at Whitley Stimpson. I actually did listen to the budget yesterday, and I thought the very funniest moment was the discussion of the global tax breaks for flying the red ensign, and which I've been looking at flying on my boat for years. I don't think my little river cruise is going to qualify for the global tax breaks, but the reason I found that quite amusing is because the Chancellor actually said to the opposition, there's going to be lots of red flags flying, but they're going to be out at sea, which I thought was quite amusing. The presenters today are Owen Kyffin. He's a tax director, a chartered tax advisor from Banbury, and Luke Wiseman, who's a chartered accountant, a director at our Whitney office. The format will be that they will deliver the analysis of the budget, and at the end, there'll be a session for questions and answers. There's a little box which you'll be able to see, hopefully, where you can ask your questions and they will deliver the answers to those, hopefully, at the end of the budget. We have 120 odd delegates, which is a very nice number. So hopefully there will be some good, juicy questions for them to get into. And I'd like to thank Maria, Molly and Caitlin, our marketing team, for putting this on. So I shall hand over to Owen and Luke. Thank you.
Good morning, ladies and gentlemen. Welcome to the budget seminar. Luke and I sat down and listened to the Chancellor speak yesterday and then had to trawl through the press releases because that's very often where they hide away some bits and pieces. So, Luke, are you doing the slides?
Yes, morning everyone.
So what sort of a budget was it for you? We normally ask this at this point and then look at the tax changes that have come through and try and analyse how our clients have come out of it and what opportunities and threats there are for them. But this year was a bit unusual. If we can move on. He started off by painting a picture of a country coming out of COVID and recovering, with the economy recovering faster than he anticipated. So that was very upbeat, but that immediately led to the heat within the economy causing inflationary pressures, which are ahead of where I think he and the Bank of England would like to see them. He then turned his speech to address some of the problems that some of our industries and supply chains are facing at the moment. I won't go into the details of these because they're absolutely nothing to do with tax, but he did talk through some steps he's trying to take to make things ease up in the supply chain. And then he started to talk about fiscal matters in some more detail thereafter. So, this was the most interesting bit. I was flicking around on the internet whilst he was speaking because, this isn't a party political point, but like when any politician is making a speech, there's quite a lot of waffle, and we were really waiting to get to the press releases, which they post after he sits down, where we find the detail. But this is the wandering lady walrus that I think's been spotted in Ireland. She appears to have made her way to Holland now, and she was pictured, I think, on the Telegraph when I was looking to see whether they had the press releases. She's made her temporary resting place on top of a Netherlands submarine, which is a walrus class submarine. So whilst I should have been thinking about tax and press releases, I was just mildly amused by the fact that there was a walrus on top of a walrus in a Netherlands shipyard somewhere. Anyway, that was just an observation. What were we expecting? Well, not a lot, because he told us most of the significant changes already, and he'd announced tax increases, and he'd even been told off by the Speaker of the House of Commons for giving too much away in advance of actually standing up and making his speech. So what did we get? Well, in mortal words of Paul Daniels, not a lot, because he'd already said it all. So what we're going to do is we're going to run through what we knew was possibly going to happen and what the impacts might be for you, and then do a roundup of a few of the things that were tucked away, which we didn't know about. So the headlines really were, as already announced, corporation tax rates are to increase from 2023. Seems unusual for a Conservative government to be increasing corporation tax rates, but there does seem to be a feeling worldwide with the US pushing those up as well. There were business rates changes, and there was confirmation of the changes which she'd already announced some weeks ago to the health and social care levy.
So as Owen said, we spent most of our afternoon yesterday looking through some of the fine print and the press releases, and these were some of the bits we picked up of interest that were perhaps a bit more tucked away, that weren't so clear in his speech yesterday. As Owen mentioned, we've got the confirmation of changes to dividend income tax rates, changes to national insurance as part of the health and social care levy that was announced a few weeks ago. Some more details about changes to basis period reforms, making tax digital, an increase in the normal minimum pension age, which we're expecting to see in a few years' time, a welcome change to capital gains tax 30-day reporting regime, and also an increased clamping down on promoters of tax avoidance schemes.
And then on the corporate side, a few things were tucked away. He announced that he was going to have a review of the R&D regime, which he hadn't given a lot more details of. He extended the annual investment allowance of £1 million through to March 2023, which I'll cover in a few moments. He confirmed the abolition of cross-border group relief. He highlighted an intention to pursue the global minimum tax deal. There were some Freeport maps, which I'll give a little bit more detail on, and he introduced a new tax hike on corporation tax for residential property developers.
So looking into a bit more detail on the personal tax side of things, what do we have? So personal tax rates, largely unchanged. Income tax rates staying the same, 20, 40 and 45% additional rate. No changes or surprises there particularly. Rate bands staying the same again, as they announced in the budget back in March. We're expecting to see those stay the same until 2026. So £12,570 personal allowance, higher rate band kicking in at 50,270, and then the additional rate coming in at 150,000. The big change, which was announced a few weeks ago, as Owen said, so no big surprises in the actual budget, but the detail again being confirmed due to the health and social care levy. Dividend rates are going to increase from April 22. So we're going to see the 7.5% go up to 8.75, the higher rate go up to 33.75, and then the additional rate 39.35%. So increases to dividend taxes across the board there. No change to the £2,000 a year tax-free allowance, so still wise to make use of that. You know, anyone who does receive any dividend income making use of the tax-free allowance. We kind of ran the sums. It looks as though, unfortunately, anyone who's taking dividends up to about the higher rate band is going to be hit by about £500 increase in their income tax due to the dividend changes from 2022. And this is being reflected in national insurance rates as well. So the health and social care levy, they announced back in September. This is expected to be a 1.25% increase from April 22 across classes 1, 1A, 1B and class 4 national insurance. Class 1 is on employment income. That's going to be for employee and employers contributions. So both sides going up. Class 1A is national insurance on benefits in kind. So again, that's going up. Class 4 for the self-employed traders among you. Again, all going up by 1.25% from April next year. We've been told that the way the levy will work is that there'll be a national insurance increase for 2022-23. And then once HMRC have sorted their systems out, they're going to introduce a specific levy, which will be shown separately on payslips, tax returns for the 1.25%, and national insurance rates will drop back down at that point. NI thresholds will increase with CPI as we see every year, but the upper earnings limit is expected to stay aligned with the high rate of income tax band that we've got at the moment. We also had pre-budget some announcements on making tax digital. We're expecting to see some changes for income tax self-assessment coming from April 23. That's been pushed back 12 months to April 24 due to COVID. This, for those who don't know, is going to be quarterly reporting for anyone with self-employment income or property income of over £10,000. That's income, not profit, just to make sure people are aware of that. We're going to see quarterly reporting for all those individuals with a final fifth return at the end of the year to catch up and make any adjustments as necessary. We're also at that point going to see some changes to basis periods. So these are a transition for sole traders who don't have a 31st March, 5th April year end. We might see profits being taxed sooner than they are at the moment. So just to watch out for some potential cash flow issues on tax when that comes in 23-24. No changes to entity for VAT, no changes to VAT at all as far as we saw in the budget yesterday. But any VAT registered businesses are expected to come into making tax digital from April next year. Previously, we'd had only those who were over the VAT registration threshold of £85,000. April will see all VAT registered businesses come into making tax digital from next year. Pensions, again, not much news on pensions, which is always good news for us. No changes to the allowances or limits. We're still seeing annual contributions of up to £40,000 per tax year, with also an option to go back up to 3 years for any unused allowances. Lifetime allowance for pension contributions is still just over £1 million, and there's still the option to take 25% of your pension tax-free once you reach the minimum pension age. What was hidden away in some of the press releases that we found yesterday afternoon was an increase to the normal minimum pension age from 55 to 57, coming in from April 28. So a few years' time, but that's coming in a few years. No changes to auto enrolment for those who are employed. So still the 3 and 5% minimum pension contributions for qualifying employees. Capital gains tax, again, no real news on this. There was a big consultation that was announced early part of the year, and we were expecting to see some changes, perhaps bringing capital gains tax rates in line with income tax. At the moment, they are 10 and 20% for basic and higher rate capital gains. Changes slightly for gains on residential property, 18 and 28%. But again, no announcement of any of those changes at the moment. So still 10 and 20%, still worth bearing those in mind. If there are any capital gains, potentially they're going to be increased at some point in the future, but with no indication of when that might be. One of the announcements that was very welcome was a change to the 30-day reporting regime. So this is for sales or disposals of UK residential property. Since April last year, we've had 30 days to report any gains and pay any tax to HMRC. That's been extended to 60 days as of last night, so a very welcome change there. The final bit from me, at the moment, it was just a continued policy intent from the government that they are cracking down on promoters of tax avoidance schemes. HMRC have been given new powers to freeze promoters' assets, to shut down organisations that are promoting and selling these schemes. And as we've always said, if it sounds and looks too good to be true, then it probably is worth steering clear of those types of schemes.
Right, back to me to cover corporation tax and business taxes. And apologies, first of all, if I keep sipping at my tea, but I've had this cold and I'm not sure my voice will last without some assistance. Anyway, so business tax and corporation tax. So main corporation tax rate is staying at 19% for 2022. But then from 1st of April 23, there is an increase for businesses which are highly profitable, which have profits in excess of 250,000, the corporation tax rate is jumping up to 25%. So that's a 6% increase, which is quite a significant hike in percentage terms. Profits under 50,000 will continue to be taxed at 19%, and there will be a hybrid rate for profits between the £50,000 mark and the £250,000 mark, which for those old enough to remember will mean a return to the very fiddly marginal rate calculations. But in shorthand terms, the way it works is effectively up to 50,000, you pay 19%. Between 50,000 and 250,000, you're actually paying profits of tax of 26.5% of those profits because of the way that they're dragging everything up. So that's effectively your highest rate between 50 and 250,000. And then once you get to the 250,000, it's just a straight 25%. So there could be some issues there for companies with year ends which span the 31st of March 2023. And we do need, again, to start to beware of associated companies, because those limits and those bans will be divided by the number of companies that are under common control. One thing it will do, and it will drive us to need to do much more urgently than we maybe do at the moment, is to look at pre-year-end, pre-accounting year-end planning for companies much more closely, so that we consider whether we need to make any pension contributions or bonuses, accruals, just in advance of the year end in order to bring those profits back under the 50,000, if that is relevant, or as near down to the 50,000 as we can if you're in the marginal rate and therefore paying at 26.5%. So consideration of making bonus payments or pension contributions, also possibly consideration of making capital acquisitions in advance of the year end to use that annual investment allowance, again, to get the profits down to a more manageable rate. I mentioned changes to research and development. Bear with me 1 second. Sun's come out and suddenly I can't see my screen. Sorry about that. Hope I haven't disappeared. So this was one where there was quite a heavy subtext going on in what the Chancellor said when he was speaking. I sensed a kind of sense of disappointment that R&D hadn't increased to the levels where he would like to see it. So he announced he would like to see an increase in R&D spend from 0.7% of the UK GDP to 1.1% of GDP by the end of this Parliament. It's one of those unusual reliefs where I think we really ought to try and take advantage of it as much as we can, because it's a very generous relief. It's also a relief which isn't claimed as much as the government budget for. So if there's actually a relief they want to give, which lets you off paying some tax or gives you some tax back where they're not hitting their targets, it seems crazy not to try and make use of it if you possibly can. The other changes he announced yesterday was that he confirmed what had been previously suggested, that it will be modernized. Currently, R&D expenditure is principally allowable if it's either incurred on consumables or on staff salary costs. But to recognize the modern world and the way businesses are going now, he confirmed in his statement yesterday that these classes of expenditure will be expanded to include data and cloud computing costs as eligible. We've still got two schemes running side by side. He did announce that there will be some further consultation yesterday. He didn't say what form that would be or what it would be considering, but again, maybe it will be merging the two schemes. He did announce that there will be some restrictions introduced for relief on overseas expenditure. I mean, I'm not sure whether that's right or wrong, but I can see that there's a clear policy intent that if there is R&D being done, he'd like it to be done in this country so that the salaries and wages which are incurred in carrying it out add to the UK tax take through pay-as-you-earn on the people employed to carry out the R&D. I say this every year, but I make no apologies for saying it. It's still an extraordinarily valuable relief. So if you're a medium-sized company in the UK and you spend £100,000 on qualifying R&D, that is enhanced so that instead of getting tax relief on £100,000, you get tax relief on £230,000. So it's an uplift of 130%, which is quite extraordinarily generous. And similarly, if that uplift pushes you from being profitable to loss-making, which is not unusual with companies incurring R&D, because it's often a startup or near startup situation, and those just burn through money if you're trying to get new products to market. But so if that uplift pushes you across into a loss position, you can actually surrender that loss immediately and hand it back to HMRC in exchange for a cash refund against the loss, which, as I say, if you're burning through cash in the early days of developing product, is a very handy situation. So do consider R&D, and consider if anything you're doing is R&D. I've seen it from all the way from my very high tech clients who really are pushing the boundaries, right down to people who are basically involved in metal bashing and manufacturing, where they're trying to make a process more efficient or use a more modern process to cut down on time or cost or whatever. So certainly one, at least, even if eventually you conclude you don't have any qualifying projects, it's certainly worth considering still, in my view. As we mentioned before, the annual investment allowance of £1 million limit has been extended to March 2023. That's very welcome for people who spend a lot of money on kit. Basically, what it means is that if you spend £1 million on qualifying plant and machinery, that can all get written off against your profit in year one without having to wait for the writing down allowance, which would normally be the way capital allowances are given. It's very helpful it being extended through to March 2023, because it would originally have ended at the end of December this year, and there would undoubtedly have been confusion with people maybe spending money after the end of December, anticipating getting relief for it and not. So having a nice clear cutoff at March 2023, I think, is to be welcomed. But obviously not everyone is going to be spending £1 million on kit. The super deduction of 130% on new plant and machinery qualifying plant machinery is going to continue to be available. Need to watch that one slightly when claiming it, because of course if you turn your kit over reasonably quickly, you've got to bear in mind that if you get the super deduction, there's also potentially a sting in the tail when you sell it, in as much as you get a super balancing charge to go with it. And finally, although there was no mention of it yesterday, just to mention that company provided electric cars are still very attractive, in as much as the company can write off the cost in year one, and that the employee benefit in kind rates on a company electric vehicle are still very, very low and very cheap in tax terms. Fantastic,
says Jonathan.
Jonathan chips in with fantastic there, because I know he's just got himself a nice new electric vehicle and a low benefit in kind charge on it. So moving on again. Everything else on company and business stuff, he's abolished cross-border group relief. So whilst we were in the EU, in order to be seen to be being fair across Europe, broadly group relief, if you have two companies within a group and one makes a profit and the other makes a loss, you can just set the loss of the one straight off against the other. Whilst we were in the EU, in order to avoid claims of discrimination and unfair practice, we had to change our group relief laws to allow group relief cross borders. Now we're no longer in the EU. The government have decided to abolish that. So group relief going forward will only be available between two UK companies. He announced he is going to be looking further at a global minimum tax deal, which is being pushed by the US as well. He didn't give us very much detail on that, but he said he's going to continue looking at that going forward. Basically, it's trying to make sure that a lot of the e-commerce companies do try and pay their fair share across the globe. But we'll watch that space and see what develops. Excuse me, I haven't reproduced them here, but in the press releases that followed the budget speech yesterday, they did publish the maps of the Freeport sites that were announced last year. I didn't produce them in the presentation because they're likely to be of a limited interest to our attendees. But if you do happen to have any property or business interests in those Freeport areas and want to have a look exactly where the boundaries are, those are on HMRC's website amongst the press releases that were announced yesterday. He announced another corporation tax increase. This is a residential property development tax. So the way this will work is in the finance bill this year, they'll introduce an additional new tax on company profits, which are derived from UK residential property development. The tax will be an extra 4%, but it will only be on profits exceeding an annual allowance of £25 million. And that will be included as an additional box on the ordinary corporation tax return, as we understand it. He also announced that they're going to look at a consultation to provide some measures to make it more easy for companies that have become non-domiciled to re-domicile back to the UK. Obviously, this is a effort on his part to get companies that thought they might like to go and be in business in Ireland, because given Ireland's very low corporation tax, historical low corporation tax rates, although I believe that's now changing, he'd like to see them back in the UK, employing people and paying taxes in the UK. So he's looking at a raft of schemes to try and make that easier for him. And finally, again, going back to hand in hand with the global minimum tax deal, he's announced further consultations on online sales taxes to try and level the playing field a little bit between e-commerce companies and your more regular high street retailers. So now we just have a quick whip through the other bits and pieces and odds and ends that were buried away. As I said, it's going to be relatively short presentation today, given how much he didn't really say yesterday. So we'll move on just to look at the tail end of these. So business rates, as you probably heard, he has reduced the revaluation period to every 3 years, which may be of some help. He's introduced a new business rates improvement relief. So if you carry out fast improvements to your business premises, which would normally push up the business rates, you've now got a year's deferral on that. He has scrapped the increase in the business rates multiplier, which had been proposed. So that's another easement method. And he's granted a 50% discount for anyone involved in retail, leisure or hospitality sector up to a sum of £110,000.
Moving to alcohol duties, seems to be a favourite over the last few years. Made quite a big deal about this in his speech yesterday. The biggest overhaul to alcohol duty for 140 years. A radical simplification from 15 main rates down to only 6. Looking at, there'll be some increases and decreases. So stronger drinks, those over 11% alcohol are going to have their rates increased. And then those with lower alcohol percentages are going to be coming down. Announced the new small producer relief. So for the likes of local breweries, producers of craft beers, ciders, those who produce those drinks with a strength of less than 8.5%, there's going to be a further relief for those. A draft relief was announced for reducing the tax on drinks served from pumps. So your pints of beers and ciders when you go to the pub, going to bring the cost of a pint down by about 3p. Also a duty cut on sparkling wines and fruit ciders. There's been a bit of a mismatch in terms of Sparkling wines with a lower alcohol content being taxed more heavily than some still wines. So those are coming back in line. Good news for those who like champagne and Prosecco and the likes.
Yeah, and then just a few things he tagged right on at the end, which aren't strictly to do with tax, but we thought we'd mention, basically because he gave us so little to talk about. The universal credit taper reduction he announced. So if you're receiving universal credit and you work, there's a clawback of some of the universal credit that you've received, which was up to 63% of that. That's been reduced to 55%. Obviously, a lot of people would have liked to have seen that even further reduced, but principally it's to stop it being a discouragement to people to work, because if they work and get some extra money, they actually keep more of it rather than just refunding universal credit under the taper scheme. He scrapped fuel duty increases. Kind of seemed inevitable that he'd have to try and do something to help with fuel costs the way they've rocketed recently. So he's just scrapped those for now. And he also mentioned the national living wage is going to be increased to £9.50 an hour, which was one of the things the Labour Party were calling for. So he's kind of stolen their thunder a wee bit on that one. So I'm not sure where that brings us to now, Luke. Oh yeah, so that was the October, that was the budget as we saw it. I suppose one of the things with him not saying much is really to look at the areas where there has been constant talk and rumour that there might be some changes with some of the more generous tax reliefs that there are around, and observe that he didn't make any of the rumoured changes or the feared changes yesterday. So CGT, there was a lot of talk about CGT being aligned with income tax rates. That wasn't, there was no mention of that. So CGT remains at 20% top rate or 28% for residential property. There was a recommendation for the Board for Tax Reform that they should be aligned with income tax rates. So there was an expectation we might see them go up to 40 or 45% capital gains tax rates. So therefore, if you have got any assets which have got heavy inherent gain in them, it might be worth, since he's done nothing this time, seeing whether you can wash those gains through if cash flow permits and get them sold and repurchased maybe before the next budget. Equally, there was a lot of talk of business asset disposal relief, the old entrepreneurs relief, which replaced a long time ago retirement relief, which reduces the rate of tax on selling business assets or indeed your business on that to 10% on the first £1 million. There was a lot of talk of that being scrapped. Again, it didn't go. So again, if you're thinking of maybe retiring and passing the family business on to the next generation or onto your senior management team, maybe get that done sooner rather than later, because it did look ripe to be scrapped. And there was a lot of calls for it to be scrapped. So maybe if it's something that is in your mind, concentrate your mind on maybe doing it before the next budget rather than later. As Luke mentioned, there's been much talk now for the past 3 or 4 years of drastically restricting the reliefs on pensions, reducing the lifetime allowance, reducing the tax rate from your highest rate of tax to 20%, reducing the annual allowance from 40,000 down to a much lower figure. Again, absolutely no changes yet. I know a lot of people in anticipation of possible changes will already have maxed their pension out, but if you haven't, and if you are in a position to look at it, it may well be worth doing something sooner rather than later. Capital allowances, again, we've got the very generous annual investment allowance at the moment. Maybe worth taking advantage of that whilst it's still here if you've got a lot of CapEx in mind. And finally, the biggest non-event of yesterday there has been so much talk and indeed recommendations from the Department for Tax Reform of an extensive overhaul of inheritance tax. Absolutely nothing mentioned today. There was not a single mention of IHT in the speech or in any of the press releases which we could see. So everything is still up for grabs there in terms of gifts, potentially exempt transfers, use of trusts, etc., to get stuff out of your estate. So again, it kind of feels inevitably that there's going to be a change and a tightening up at some point. So again, if you're thinking of getting stuff down to the next generation or structuring your affairs in a more time efficient, in a more tax efficient manner, maybe again it's time to strike before changes are made. So I think that's about all from me, Luke, unless you've thought of anything else you wanted to add.
I think that's covered it very nicely, Owen. Thank you. It looks like there's a few questions. Shall I read those out, Owen, and then we can see how we can address those. So there's one here about the health and social care levy that's not going to be distinguished as such until 2023. Therefore, over the 22-23 tax year, you're going to be able to exchange this under a salary exchange arrangement. Going forward from 23, you'd not be able to exchange this 1.25% over this. As far as I've seen it, it's going to be, I'm trying to read through the question. I've not seen anything on the salary exchange arrangement. All I've seen is the details on the 1.25% being increased to all levels of national insurance. For those, I'm not sure if I mentioned, of state pension age, won't be impacted by the increases to national insurance from 22-23, but they will be impacted the following year when the specific health and social care levy comes in. So anyone of state pension age, just to watch out for that coming in from 23 onwards. Question here about changes to corporation tax. Should we defer large purchases until the new lower corporation tax year end is December 31st? I think in terms of the changes to corporation tax, given the generous reliefs of AIA and the super deduction at the moment, there's no need to defer any big purchases until corporation tax rates go up at all.
I suppose the only thing, Lucas, if you can defer it and you don't need to incur the expenditure now, obviously relief is going to could potentially be at 25% rather than 19%. But honestly, if your business needs a bit of kit now, that might, I think that's probably one to have a specific word with us on and have a look at your cash flows and what your likely spend is on a case-by-case basis.
Another question here, is it your guess that entrepreneurs relief might be abolished in March 22? On your feeling of when business asset disposal relief might go, Owen?
Well, your guess is as good as mine, frankly. I just get there's been a lot of pressure on him to tamper with capital gains tax, but he seems to have resisted it thus far. And, you know, I can see some sense in that because in relative terms, very few of the population pay capital gains tax. So the overall take is very far, is relatively small compared to the take from other taxes. Consequently, as well as maybe keeping his city mates cheerful, who probably do pay capital gains tax, if you need to raise a lot of money fast, it's much, you know, if you whack 1.25% on national insurance, well, the whole working population pretty much pay that. So you're going to get a lot more easily, to be perfectly honest. So I don't know. I honestly don't know. There's been constant talk about business asset disposal relief going and rates on capital gains tax generally increasing, but he hasn't grasped the nettle yet, and I sense a reluctance to, but obviously I don't know what the inner workings of his mind is on that one.
Yeah, I think I'd agree as a final point. I think the announcements early part of the year to increase those rates, they didn't do it at that point. They've not taken the opportunity to do it now. Perhaps it's just something that's not on the agenda. There's no appetite to increase those rates at the moment. Wait and see, I think. I think those are all the questions we had. Been asked just to let you know that we'll be following up with an email with some useful links, recording of the webinar, and so on. Obviously, if anyone has any other questions, I'm sure Owen and I will be available, as well as your normal contacts at Whitley Stimpson.
Oh, Graham Pardew was just...
Graham, sorry, Graham. Sorry, Graham. The national insurance increases, big concern along with any other pay increases. Yes, we've touched on those, Graham, and there'll be a summary again on the recording that comes out. Unfortunately, I think as Owen just mentioned, it was an easy target to catch most of the working population by increasing national insurance. It's a tax that most working age people will pay somewhere along the line, whether it be through national insurance as an employee, through class 4 self-employed, and indeed they've caught dividends within that as well. So yeah, we can see it going up, and it's going to be a bit of a hit to some people.
And I don't know whether Jonathan had any final words or whether it's...
No, I have no final words. I think the levy itself, has already been said, is a separate type of tax. The interaction of that levy with salary sacrifice, I read an article at the end of September, and it was unclear how if you could use the salary sacrifice for the levy. What was being mooted at the point was, with rises in national insurance, other options available to reward employees with things like share schemes, where there are several approved HMRC share schemes where actually you can send out a sort of small value percentage of shares with a small number. So people are beginning to look at those as a sort of a salary sacrifice option as well. But no, I think that was wonderful. Thank you very much. So I'd like to thank Owen, who's just surviving at the moment, and Luke for their presentation. And if anyone has any questions, as they said, please contact either them or myself or anyone else at Whitley Stimpson that you normally deal with. But thank you very much.
Thank you, everyone.
Thanks very much. Cheerio.